Hi everyone, my name is Henk and welcome back to the channel. So recently there's been many news headlines of experts predicting a possible negative interest rate in 2021. So in this video we'll be taking a look at what negative interest rates are in very simple terms and what you should do if the interest rate does indeed become negative. So without further ado, let's get straight into it. So in order to understand the effects of negative interest rates, we need to have a quick look at our friend inflation. Inflation is the increase of prices of goods over time. For example, a loaf of bread may cost only 50 cents, let's say 30 years ago, and today it costs around $3. This is where the central bank comes in. The main role of the central bank, and here in New Zealand we call it the Reserve Bank of New Zealand, is to control the rate of inflation. Now ideally the Reserve Bank wants to keep the inflation rate around 2 to 3%. If it's too high, everything will become too expensive really quickly. However, if it's too low, nobody will want to spend anything and the economy won't grow. The main tool that they use to control the rate of inflation is to adjust the interest rate. Here in New Zealand, we also call it the official cash rate, the OCR. So I have a video explaining what the official cash rate is, and I will link it to the description above. If the interest rate is low, credit is cheap, and people won't want to hold on to cash, and they are more likely to go out and spend it on buying goods or products. So the economy is stimulated, therefore the inflation increases. However, on the other hand, if the interest rate is really high, people tend to hoard their cash into their savings account, which means that people are spending less on average. Therefore, the inflation decreases. The flip side of inflation is deflation. Now, deflation happens when the consumers are unwilling to spend money and are content sitting on a pile of cash. Now, retailers in this situation will more likely to lower their prices because they are competing for customers that don't really want to spend their money. In most countries, this seems like a pretty far-fetched idea. I mean, prices always increase, right? Well, that is not the case in Japan, which has gone through almost 2 decades worth of deflation, where increase in prices were heavily frowned upon. And there have been instances of people boycotting restaurants because they have increased their price by 100 yen, which is roughly the equivalent of $1 US. Several economists at major banks in New Zealand, such as ANZ and ASB, are now predicting that the Reserve Bank will take the official cash rate, the OCR, into the negatives next year. Currently, the OCR is at a historic low at 0.25%, and they're predicting a drop of 50 basis points, which will take it to negative 0.25% by April of next year. A low OCR will affect all forms of interest rates, and this means that you can get low interest rates on your mortgage, but also you'll get lower interest on your savings account. Currently, the mortgage rate is also at a historic low, which is part of the reason why, as the whole economy is going into a recession, the housing prices still remains really high. In fact, several regions have recorded an increase in housing price, even as businesses around it keep on shutting down. So what does that all even mean for you and me, the everyday customer? Now, if the interest rate is negative, does this mean that you have to pay the bank to hold on to your money? And does this mean that you will get paid by the bank to take out a loan? The simple answer to these two questions is no and no, but there's a little bit more details to that. Sweden was the first country in the world to cut its interest rates into the negatives back in 2009, when they cut their interest rate to negative 0.25%. But this negative only applies when the commercial banks deposit cash with the central bank. The interest rate when commercial banks take out loans from the central bank is still positive. So this is like the difference between your 1% savings account and your 3% mortgage home loan rate. Therefore, if the interest rates are slightly negative, as a retail customer, you might not be getting any interest on your savings account with your bank, but it's highly unlikely that you have to pay the bank to hold on to your money. On the other hand, it is also highly unlikely that the bank will pay you to take out a loan with them. What the negative interest rates would really affect are institutions, governments, and fund managers who would have a tighter margin to make a profit when there's a negative interest rate. However, this may all change if interest rates go into deep negative territory, such as negative 1% or even further, so that it actually starts affecting the retail customers as well. Now, this is something that no country has yet tried, and it may well cause an economic catastrophe, but that's yet to be seen. Several other European nations has followed the path of Sweden within the last decade and lowered their interest rate into the negative territory. But while it certainly lowered the cost to borrow money, it didn't actually really increase the demands for people to go out and spend the money to buy goods. Now, businesses still aren't spending that much because there isn't a sudden spike in consumer demand for the goods and services, which means that simply lowering the interest rate only have a moderate effect of actually stimulating the economy. The next question is, what should you actually do? Now, one of the main problems with very low or negative interest rates is that putting money into a savings account is effectively worthless, so people need to find alternative ways of investment. This pushes people into more risky investments, such as stocks and/or real estate. While this might not be a bad thing, if you are in your 20s and 30s, when you still have many years ahead of you to grow your investment, if you are close to retirement, this presents a bit of a problem. Now, a possible solution to that is to go into dividend investing, and instead of relying on getting interest from traditional savings accounts. If you are still young and have a long investment time frame ahead of you, the negative interest rate should not really scare you at all. Now, investing consistently in good companies and index funds over the long term will always provide you with great returns. If you would like to learn more about investing, be sure to check out my investing playlist to see how you could get yourself started today. And I will see you in the next video.